National income means the total value of goods and services produced annually in a country. Good morning, everyone. Today's topic is measurement of national income. In my previous video, we had already discussed various concepts and components of national income, such as gross national production, net national production, and national income have been discussed. In this chapter, we will study various methods of national income and how it is computed. We all know that national income is a flow concept. So, it is measured in terms of produced wealth in a nation in a given period of time. We will discuss three important methods of measuring the national income: production method, income method, and expenditure method. National income can be analyzed from these three angles. Firstly, national income is the total of the monetary value of entire production in a country. For this, we will use production computation method. Secondly, the national income is the sum of all the income generated in a nation. For this, we will use income computation method. And third, national income is the sum of entire consumption of the nation. For this, we will use expenditure computation method. So let's start with the production method. This method is also known as product method or value added method. According to production method, national income is the sum of the money value of all the final goods and services produced in an economy during a given period of time, which is calculated at the market price. In this method, national income calculation is based on net value added approach. Net value added means it is the contribution of a particular sector net of intermediate product and depreciation. Intermediate goods or production is that which is used for the production of other goods. This is usually work in progress or semi-finished good. For example, thread is an intermediate product for the fabric production. The problem of intermediate good is more where the production process is quite long and passes through various stages. Here we will look at one example. It is clear from this table that the net value added is rupees 10,000. Means 5,000 plus 2,000 plus 3,000. However, we can see that the total production seems to be 22,000 if we'll add all the values, that is 5,000 plus 7,000 plus 10,000. It is clear that if net value added approach is not adopted, then there are chances of inflation in the national income. Here we have calculated net value at all the three processes. In the first process, net value is 5,000. In the second process, when cotton is converted into thread, it is 2,000, and when the thread is weaved into the cloth, the net value calculated is 3,000. So the total is 10,000. So we can say 10,000 is the gross value added at the market price or GDP at the market price. Value added means GDP at the market price, deducting depreciation, adding net factor income from abroad. This is called NNP at the factor cost, which is the national income. Value added can also be calculated through the formula value of output minus intermediate consumption. It can be in the form of domestic or in the form of imports. Value of output can be calculated by adding sales and change in stock. Change in stock is the difference of the opening stock and the closing stock. In this way, you will be able to calculate national income with the help of production method. But there are certain limitations while calculating income through this method. There are some chances of double counting in this method. This may be more severe in those sectors where production passes through several stages. Second, it is difficult to value the entire production of the country, which differs with each other in quality to the great extent. Third, it is difficult to decide which production is final production and which is intermediate production, especially in the cases of services. Next, it is also difficult to decide the actual value of depreciation in the production process, and in this method non-monetized sector or the goods which are exchanged through the barter system is also not included in the national income. So these are the certain difficulties of the production method of calculating national income. Now, the second method is income method. It is also known as distributive share method, factor payment approach or allocative approach. The factor of production land, labor, capital, entrepreneur and organization produces gross national production, and the value of goods and services is allocated as the income to all the factor of production in form of rent, wages, interest and profit respectively. The income method of calculating gross national production consider the GNP as the value of goods and services produced in a country, which is allocated as the income to all the factor of production. So, flow of income to the factor of production is called factor payment. And factor payment are wages and salaries for labor, rent for the land, interest for the capital, and profit for entrepreneurs and organization. This is also called as factor payment approach, as the income from the entire production is termed as payment made to factor of production. It is also termed as allocative approach because the total income derived from the production is allocated among the factor of production. We can say the entire income of the income tax payers of all the economic units and income of non-income tax payer is added to find out the total national income. So this method is more useful in the developed countries where people maintain their income records regularly and correctly. In this method, only the income earned by the owner of the primary factor of production are included in the national income, and transfer payments are not included. Illegal income is not the part of national income. Windfall gains, sale and purchase of the second-hand goods, imputed and self-occupied houses is included, but windfall gains and sale and purchase of second-hand goods are avoided. So this method is little bit complicated, not suitable for the developing nation, and people usually do not disclose their income. So it is not suited to the developing nation. This is all about the income method. Now we will study the third method, that is called expenditure method. This method involves calculation of gross national production on the expenditure method, as the prices paid by the consumer to the producer for goods and services is the income of the producer. It is based on the concept of commodity flow from producers to the consumer, and in turn the expenditure from the consumer in money terms to the producers. So the national income is the money paid by the consumer to the producers for the final production they receive. So this is called expenditure method. Again, national income is a flow concept. Here the expenditure is divided into three categories: private expenditure, investment expenditure and government expenditure. Private expenditure, which is done by the individual. Investment expenditure is the expenditure for the investment purpose, which is incurred by the entrepreneurs and the firms. This results in the capital formation in an economy. Finally, the government expenditure include all the expenditure done by the government in a country. So, we can say the gross national production is the sum of all the expenditure in an economy in a given period of time. Symbolically, Y is equals to C plus I plus G plus X minus M. Y stands for national income, C stands for total expenditure on consumption, I stands for total expenditure on investment, G stands for total government expenditure, X minus M is the net income from the abroad. So while calculating national income with the expenditure method, you have to keep in mind that all transfer payments are excluded. Expenditure on the purchase of second hand goods should be excluded. Expenditure on the intermediate goods should be excluded. And finally, the expenditure on the financial assets which are produced and owned within the country is also excluded. But the expenditure on financial assets of foreign countries is included in the national expenditure. So, the difference of both is called net foreign investment. There are certain limitations of this method, like many transactions are carried out on the credit basis in which no money expenditure is involved. And the second one is the barter and the self consumption of the production. So, this is the third method. I hope now it is clear to everyone that how national income is estimated through these three methods. Thank you. And if you are new to this channel, kindly like, share and subscribe this channel and share it to your friends if you like the video. Thank you so much for today. Have a nice day.